Welcome to Financial Discretion Advised. I'm Tyler Hafford. I want to apologize for the big gap in between episodes, but I think we have a good one today that is addressing a topic that's probably top of mind for a lot of Americans, certainly top of the headlines lately. And to talk about recession, we have certified financial planner Libby McKay on the show today. Libby, I want to say, is a new lead advisor at Penobscot Financial Advisor, but not new anymore. Geez, we've been doing this for a little while, haven't we?
Yeah, since January. It's flown by.
Nice. Yeah, so Libby, why don't you give us a little bit of your background? How did you get to where you are today?
Sure. So I was a career changer. My degree was in biology. So I took the long road to become a financial advisor. But I started working at a fee-only financial planning firm in Kentucky about 2018, so 4 years ago. After studying for the CFP and passing the exam. So I've been doing fee-only financial planning for a while now and really enjoying it and happy to be here on the team.
Yeah.
Loving being in Maine. So
Good. Well, we're happy to have you on the team. Great financial planner. And I'm a political science major, so all good financial advisors, I think, are career changers. So anyone listening might want to look for that when they're talking to someone. But to help everyone get to know you a little bit more, I've prepared 4 questions, and I have not asked these to Libby yet, so these are all brand new. We'd appreciate it if you didn't think and you just answered, so we can get a true feeling of who you are. We just came out of Halloween. Really important question: favorite Halloween candy?
ooh, I have to go with Whoppers, which I know is a weird one.
Yeah, wrong answer there. So new-ish to Maine, came up from Kentucky. I know you've spent some time up here. What's your favorite thing about Maine?
I love hiking. So I love all the trails in the area, along the coast, up the mountains.
Nice.
So yeah, I just love getting outdoors in Maine.
All right, that's a good one. Lake or ocean?
Ooh, I think ocean, not because I get in it. But I love being by the coast. I love the salt air, but I do love going to Maine's lakes to go swimming.
Yeah.
But yeah, I think ocean is the winner for me.
All right. And then final question. You have $1,000 to your name. That's it. And I know you're a good financial planner, so you can't put this in a savings account and you have no debt. Okay. You have $1,000. You can only buy either a stock or a bond. What are you buying?
Stock all the way.
Okay. All right. I like the risk taking. Perfect. Awesome. Well, let's dive into this kind of topic here of recession. Like I said, it's top of mind for Americans. It's top of headlines. Libby has just wrote a blog on this. You can find it on our website, penobscotfa.com. Asking the question, are we in a recession? Wanted to have her come on and just kind of talk about this because I think it's really important right now. And I think, like I said, I think a lot of folks are getting a little nervous about this. So let's kind of start off, Libby. What constitutes a recession, right? What are we looking for to say, all right, yeah, we're in a recession?
Yeah, so the old rule of thumb is 2 consecutive quarters of negative GDP. So that's kind of like the old school, just easy answer. But GDP isn't always like the perfect, measurement of an economy. So now we look to this committee that's at the National Bureau of Economic Research that pinpoints for us exactly when a recession is occurring or when the economy is slowing down. So they are in charge of pinpointing the peaks and the troughs of the business cycle. But it takes a while to do that.
Yeah, and it's kind of at conflict right now, right? So earlier this year, we did have a couple of quarters in a row of negative growth, but a lot of the other factors they're looking at are still really strong, aren't really indicating a recession, right?
Yeah, exactly. So they do look at GDP, but it's just a part of it. They also are looking at employment, incomes, personal consumption, how businesses are doing, sales, in businesses, and also industrial production. So a lot of those can be moving in different directions at the same time. But right now they're all pretty much still moving upwards for the year. We saw a couple dips in a couple of them in the middle of the year, but it's all looking still really strong, even though, we see in the headlines, oh, like housing starts are slower, obviously the home purchasing has slowed down with interest rates going up on mortgages.
Yep.
But overall, the consumer and businesses seem to be still pretty healthy and employment is still high.
Yeah.
I think just this week, we're starting to see more headlines about employment, general layoffs and that sort of thing. So we'll see what happens this month.
And starting to show up, but even this morning, today is, geez, what day are we in? November 4th here. Got some employment numbers. Looks like we created almost 300,000 jobs last month, which is much to the chagrin of the Fed right now, who is trying everything possible just to slow things down. And the economy just seems to be so strong that it's ignoring it. So when we're talking about recessions, this board that kind of declares it, they don't just kind of come out and say, hey, we're in a recession today, right? This is kind of a review of past data.
Yes, it's all looking in the rearview mirror. So that doesn't help me and you that much in determining what is going on today. It can take them, anywhere from like 4 months to 2 years to determine that, a recession was happening during this time period.
Yeah.
So they're great for kind of like looking at historical numbers, but not so great for helping us in the current day, which is why a lot of people still look to the GDP so strongly, because it's a current day temperature gauge of the economy.
Sure. And then you get some other kind of indicators like an inversion of the yield curve that you'll hear and all of those things. The problem is that a lot of these indicators can show up without us having a recession, right? So we tend to coincide the technical recession of 2 negative quarters with a recession, but it doesn't necessarily mean that we have to have a recession. So I think that's what's creating a lot of issues. And Libby, in the beginning of your blog, you kind of hit on something I think is really important for folks to realize. Recession is part of the business cycle, right? We have to go through these things. We have expansions and then we have recessions, and that's just kind of the way we go through it. And it's healthy for an economy to have these types of cycles. So as much as it's not fun to go through, I think it's important for people to remember this is just part of the process. We got to go through these every once in a while. This one, the Fed seems to be trying to induce, whether they say that or not, but we're talking about all this strength in the economy. Why is recession popping up? And I think it has something to do with the I word here that we've been hearing a lot of, and that's just inflation, right?
Right. Yeah. I mean, the Fed has 2 mandates, right? To keep price stability, which is inflation, but also to maximize employment. And right now, inflation is their number one concern. And they've made it very clear that, they're prepared to battle inflation at the expense of full employment. So that's a pretty good indicator that we can expect recession, because they're willing to let those employment numbers drop. And, a drop in employment is gonna be a big precursor to a recession usually.
Yeah, and if you think about it, it makes sense, right? So you have a drop in employment, which means people have less money to spend, which means that their behaviors start changing, which leads to business sales and industrial production reducing. So I think it is a big piece of this. Now, the Fed's not getting on TV every single day and saying, geez, we really hope the unemployment number goes up. But their actions are certainly doing that. And we can see there's some historical context to this, right? We've had a period of time in just recent, I say recent history. I was born in '89, but back in the 70s and 80s, where we saw inflation pick up, we saw an aggressive Fed led us into this recession in the early 80s. So I think inflation is obviously the big one here, but it's what it's causing the Fed to do that is making everyone start talking about is a recession coming down the road here. So so you kind of talk about in the blog some historical stuff, but there were some averages around those recessions, just like the length of them, what we saw in unemployment and things like that. You want to talk about that just quickly so folks can get an idea of how long do these things last for?
Yeah. So this blog originated just from me wondering personally, like I didn't live through the 70s. So I knew there was high inflation, but I didn't know to what extent. I didn't know the repercussions of that. So really, I was just doing personal research into, what happened during that time period. How many recessions were there due to this high inflation? How long did it last? So that was kind of like what led me to be like, this is great information that I'm learning about. I'll share it.
Yeah.
So during that time period, inflation was high for basically 10, 12 years. And when I say high, I mean up into the 20s.
Yeah. So higher than what we're seeing today.
Yes, absolutely.
Right.
Yeah. I heard a good data point actually the other day that in 1981, Paul Volcker, he had to raise the Fed funds rate to 22%. So just, we're looking at 4% and freaking out. 22%.
So yeah, and that's a really good point. And before you go on, I kind of want to hit on it. So Paul Volcker was the Fed chair at the time. Today it's Jay Powell, but their actions are starting to line up a little bit. So there's a couple things that are really, I think that's a good comparison to where we are today, but there are a couple things that are a little different. Inflation did spike higher than what we're seeing today. The interest rate environment was significantly different than what we're in today, right? We were at a very low, almost zero interest rate environment when we started the year into these rate hikes, not necessarily where they were starting in the 70s and 80s, and they went much further than what they're talking about today. Right. So a little bit of a difference there, but I think it's important to talk about. And then you can kind of take us through the averages there.
Yeah. So definitely a lot of differences from that time period, but this is really all we have in modern day monetary policy to look at in comparison, in terms of high inflation and recession. So during that period in the 70s and early 80s of high inflation, there are actually 4 different recessions, all as a result of the high inflation to a large part. Yeah. And just kind of looking at the averages of those 4 different recessions, on average, it lasted about 12 months. So average recession length of 12 months. And then thinking about some of the, results of that, overall, about a 1.7% drop in employment, a 1.6% decline in personal income, a 7% drop in sales, and almost a 9% drop in industrial production. So, as we look at these different economic indicators, and they're all still going up, we haven't seen, not even a 1 or 2% drop yet.
Yeah.
Just kind of something to give us a baseline.
Yeah. And, sales falling by 7% and industrial production falling by almost 9% doesn't sound like, oh my God, right? You're looking for like 50, 60% decline. When you're talking about an economy as large as the United States, those are massive declines. That is a big step back for the economy and a contraction here. So, and you're right, we're not seeing that drop in unemployment. Wage growth is still showing up. We're still seeing, well, I don't want to say earnings are kind of blockbuster right now. They're not degrading in the way that a recession typically does. And I think that's why there is this debate going on. Are we in a recession today? Or are we not? Yeah, we got the technical indicator, but all of these other data points are pointing to just a relatively strong economy at the moment. But the stock market has fallen upwards of close to 30% at times this year. The market's a forward leading indicator, which tells me there's some trouble ahead. So what do we think this means for the stock market, right? We're already in this bear market, and it's in that grit your teeth and kind of try to get through it. What's the market usually look like through stuff like this?
Yeah, so through these 4 different recessions, the market did dip on each one.
Yep.
And it usually started to dip before the start of the recession because it usually is leading indicator. And it was during that time as well. The average drop that we saw in the market over those 4 recessions was about 30.5%. So we've seen a 25%. This is S&P 500, I should be clear. 30.5% drop in the S&P 500. And that drop usually bottomed out about 6 months into the average 12-month recession.
Sure.
So if you think about the average length of the recession and what the market is doing, we're looking at, the first 6 months, the market starts to drop before the recession starts, continues to drop and decline, and then hits that bottom midway through the recession. And then we start to see a recovery during the second half of the recession.
Yep.
But it took about an average of 2 years to see the market fully recover from that low. So even though the recession is, we're out of the recession, it still takes about another 1.5 years for the market to actually recover back to the previous highs. Okay. So obviously the market can do, a lot of different things from the average. But that
Yeah.
just kind of gives us a nice baseline of kind of what to expect based on historical averages, because that's all we have to work with.
Yeah, and I think it's really important for investors to remember too that this crash has come with a unique factor that the bond market has sold off. So portfolios, the 60-40 portfolio is having its worst year in a century. Well, that's the time frame it takes the market to recover. The portfolio might lag a little bit just because it's going to take some time to make up on those bond losses. But you said a couple of really interesting things. The decline falls prior to the recession and into the beginning of the recession. And then the market, in the same way that it was looking ahead to see a recession, starts to price its way out, right? So a lot of folks who are trying to invest today look at what's happening right now in the real world and make their investment decisions. The problem with that is the market's already made that decision a while ago. You've kind of missed the boat. So getting conservative, right, you need to do well before a recession shows up. In fact, getting conservative as the recession's showing up, you may be putting yourself in a poor position, because that's actually when stocks really start to rally. And if I'm any good at my technical abilities, above my shoulder here, I'm going to put a chart that shows this, that shows where the economy production starts to fall, and you can see the stock market going in the other direction. The problem is we never know when that point is until it's already happened, right? So you get that indication later that, all right, you know, you're in a recession. But
I think it's so hard as an investor, because you're living through if you're living through a recession, you're feeling a lot of negative sentiment that's totally separate from the stock market. So if people around you are losing their jobs, or pay is going down, or your friend who owns a business is having trouble, you're not going to feel great about let's invest money in the stock market, when really that's probably when you should be investing in the stock market, because sentiment and stock market do not perform together.
Yes, and it's a really good reminder too that the economy and the stock market aren't the same thing, right? So they're looking at different things, and the market's trying to stay well ahead of what's coming in front of us. So I think the time to get really conservative was in January, and even that didn't really help, because the bond market didn't help us that much this year. So yeah, be aware that the market is already trying to price its way out of whatever the current situation is, whether that's good or bad. So let's talk a little bit about what this recession might look like. And I know I'm throwing a curveball at you. I didn't really prep you before this, but I'm interested on your thoughts. So we are seeing pretty strong labor market. We see wage growth. We see decent earnings. The market's very nervous about these rate hikes. And just for anyone, what these rate hikes are doing essentially is the Fed's pulling the e-brake on the economy. They want to make it very expensive to borrow money. They want to make it very difficult for businesses to continue expanding at the rate they are. They want to slow down the housing market. They want to change demand in the American consumer, and that's increasing the unemployment rate. But we're in a situation that's very different than what we saw in the 70s and 80s, where right now there's 2 jobs for every American looking for a job, right? We are still adding jobs. We are still seeing that wage growth. Not to put you on the spot, but it seems like we might not be heading into an 08-09 recession, but something a little bit more mild. Just interested in your thoughts, or if, going through this, you saw anything that kind of bucks what I'm saying here.
Yeah, no, I agree that it seems like, a lot of companies have healthy balance sheets. We're not seeing, a lot of risk at companies defaulting on debt. The consumers still seem strong, although savings have dwindled for, most Americans, and they are starting to see some higher credit card debt. It doesn't seem like, people are really hurting yet. But I think the most important thing is that the Fed remains, intent on battling inflation, because in the past, the longer inflation persists, usually the worse the recession is going to be. So the quicker we can nip this in the bud, the more likely we're to have a more mild recession. So I'm hopeful that will happen. but I don't know. I don't have the crystal ball.
Yeah, neither do I. And a couple things, that was perfect. Through the 70s and 80s, there was about a decade where the government, and I think it was 74, 75, president came out and said inflation's enemy number one. They didn't really start raising rates at an aggressive rate till the end of the decade, right? Till 78, 79. So you're right. They let it linger and they just couldn't get it under control. And you saw like a reprieve in 76, came back down and then just re-spiked back up, where it just forces this really heavy-handed Fed. What I think the Fed's trying to do today is avoid that mistake and say, if we're going to have to do this, let's do it in one shot, and get this under control. And frankly, as I said at the beginning, and you said at the beginning of your blog, these recessions are things that we have to go through in the economy. The recession, and hopefully it's a mild one, if it comes, is probably the medicine this economy needs to cool down a little bit, so we can continue to grow in a healthy way. So I think you're right. The Fed would rather see a recession than lose price stability, which would be a kind of a devastating thing. So,
I think
awesome.
I think a lot of people feel that things have been kind of overheated, the past year. We came out of the pandemic, everyone was really ready to travel, do things they hadn't gotten to do for 2 years, for good reason. But I feel like everyone kind of feels like, okay, we all need to kind of come back down to earth and kind of just steady things out.
Let's slow things down. And it makes sense, right? We came out of the pandemic, we flooded the economy with just a ton of money, allowed companies to continue to expand and grow, and we just heated it up a little too much. And eventually we're going to have to pay the price for that. I think that's what's going on now. So hopefully the Fed can make this as soft as possible for us and we can move on. Libby, I want to thank you for coming on today. This was great. Anyone who would like to read Libby's blog, right on penobscotfa.com. We're hoping to get her active with more of these blogs because I think she's at least significantly better than me. But thanks, Libby, for joining us.
Thanks for having me. Good talking to you.
See ya.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Thank you.